Regardless of your role within an organization, financial literacy is a valuable skill to hone and sharpen. Financial literacy is an essential ability for anyone employed in the professional business world. It's also vital for anyone working in a business to understand the economic levels and drivers that push their business strategies forward. So let's discuss financial literacy in detail today. Before moving ahead, welcome to Finance Functionality, your go-to channel for finance and money management. Please take a moment to tap the like button, and if you have not yet, go hit the subscribe button to stay connected to Finance Functionality. Financial literacy is the convergence of economic, credit, and debt management necessary to make financially responsible decisions. Decisions that are integral to our everyday lives. Financial literacy includes understanding how a checking account works, managing a credit card, and avoiding debt. As consumer habits and financial products change, financial literacy has taken a blow. In past generations, cash was used for most daily purchases. Today, it's rarely the case with the ease of access to credit and debit cards. The way we shop has changed as well. That's why before jumping ahead, everyone should learn the core principles of financial literacy. Let's begin. Number 1. Budget your money. Pay yourself first. Money can be used for 4 fundamental purposes: spending, investing, saving, and giving away. Finding the right balance between these 4 categories is critical, and a budget can be a helpful tool in this regard. Thinking about and tracking your short and long-term financial goals is a vital first step in making a budget. It will assist in establishing a baseline for setting out and implementing specific plans. Many people use this budgeting formula. Savings is equal to income minus expenses. However, here is the formula for financial success. Expenses are equal to income minus savings. Savings should be prioritized and factored into the budget plan, while expenditures should be planned and paid from the money left over after savings have been taken into account. Consider setting aside a fixed sum regularly, such as through a pre-authorized contribution plan, where funds are taken from a paycheck and deposited in an investment vehicle, or savings plan, to prioritize your savings in your budget. When creating a budget and making sure it's appropriately logged, it's essential to factor in all lifestyle expenditures and other financial elements. Number 2. Taxation. It's not all yours. Understand your true earnings and how they are taxed. Jobs and investments are the primary source of income. Both of these sources could be taxed in many ways and at varying amounts. It's essential to consider the disparity between marginal and average tax rates. Your marginal tax rate is the amount of income tax you'll have to pay for the next dollar you receive. Your average tax rate is measured by dividing your gross income tax obligation by your total income. In addition to federal tax rates, provincial and territorial tax rates differ. Keep in mind there are tax implications in different aspects of asset management. There may be ways to integrate future tax benefits into your plans, but these actions may also have negative tax implications. Furthermore, taxes should not be the only factor to consider when deciding on your situation's best investments. It's essential to consider the after-tax rate of return when calculating tax-efficient investments. As a result, it's vital to speak with a trained tax advisor to understand your circumstances and needs. Number 3. Plan before investing. Think about and map your goals. Identifying your short and long-term financial objectives, this will help you determine which types of investments and planning strategies are most appropriate in helping you save for your needs. It's critical to first differentiate between what is ideal and what is achievable. After going through this phase, you will set achievable goals that you can work towards with confidence. There are 2 approaches to financial planning. Number 1, a simple projection. A straightforward cash flow analysis that considers both short and long-term objectives. Number 2, detailed plan. An extensive wealth plan, also known as a financial plan, aids individuals in achieving more complex financial goals throughout their lives and beyond. The wealth stage is essential. Your current and future financial situation, as well as the financial and investment decisions you make, will be influenced significantly by your stage of life. Throughout a person's life, there are 3 significant wealth phases that they pass through. Early savers, starting a job, probably purchasing a house, marrying, or starting a family. earning, investing, and rising savings are the main goals. Midlife accumulators, secure job, homeowner, beginning to contemplate retirement, estate planning, and wealth transfer to children. Key goals, building a well-balanced preservation and development portfolio. Estate and wealth transfer preparation is a priority if you plan to retire and wish to work less. Use accumulated wealth to produce income as a salary substitute. If you're making a simple wealth forecast or a more comprehensive wealth strategy, you'll need to evaluate and interpret all of your financial details. Once you have a decent record, modify and tweak your finances until the desired goals have been achieved. Individual circumstances can affect the outcome and how you execute the outline to achieve your financial goals. Friend, we hope you are enjoying the video so far. Don't forget to subscribe to the channel. If you want to add more to the list, please comment below. Your thoughts mean a lot to us. Number 4, invest to achieve your goals. Match your financial vision with the right investments. Although there are many investment opportunities, the two main categories which are significant are registered and non-registered. These two may have a significant impact for investors. Registered. Accounts and programs that are either registered with the government for income tax purposes, including tax deferral benefits. Non-registered. Accounts that are not registered with the federal government have no restrictions and receive income that must be declared each year as taxable income. Recognizing the risk-reward relationship. Risk and return have a clear correlation in the investment world. In general, the higher the potential return, the greater the risk that an investor should be willing to take. Keep in mind that most forms of investments do not guarantee a profit. Don't put all your eggs in one basket, as the saying goes. When it comes to investing, diversification is crucial, which means finding the right combination of assets and building a portfolio that contains a variety of asset classes to reduce total risk and volatility. What kind of investor do you consider yourself to be? When putting together an investment portfolio, you can first determine your risk tolerance, which is the amount of market volatility, specifically ups and downs, that you can reasonably expect throughout your period. Choosing your risk tolerance will help you determine the type of portfolio that best meets your needs and manage expectations through bear markets. You'll be in a great place to invest in a portfolio that aligns with your overall priorities and objectives as an investor, if you know where you fall on the risk tolerance continuum. Number 5, preparing your estate. Protect yourself, your family, and all of your assets. Your estate includes all you own, including your car, house, and other real estates, as well as your bank and investment accounts and personal belongings. What is the concept of estate planning? Although writing a will is an essential phase in the estate planning process, estate planning is a more comprehensive process that involves tasks and decisions for the management and disposition and transfer of a person's assets. It will help ensure that your properties are passed on to your descendants in the most tax-efficient way, when used in conjunction with your will. Since your goals and conditions change over time, it's essential to evaluate and revisit your estate plans every few years, or after a significant event. Number 6, know the difference. Income statement versus balance sheet. Regardless of the industry, it's essential to consider how various types of transactions affect your income statement and balance sheets. The ability to define these relationships will pave the way for more in-depth market analysis. For example, while an inventory balance is helpful on its own, comparing it to annual revenue and measuring a day's sales of inventory ratio offers a much clearer image of a company's usual business cycle. Regardless of their status, all workers should be involved in the financial performance of the company. Particularly critical now as economic uncertainty continues to affect the business world significantly. Investing in financial literacy for your business, whether by programs or pieces of training, will help you boost your competencies, competitive advantage, and economic success prospects. If you want to grow your finances, you should concentrate on these 6 principles. You may still have some questions related to financial literacy. If so, leave them in the comments section below. We will help you with everything we can. If you have not subscribed to our channel yet, then subscribe and hit the notification button to get notifications on our latest content. If you want to make money and enjoy financial freedom, then finance functionality is for you. Thanks for your time. See you next time.